Guys, I'm going to let you in on a secret that sounds crazy at first. Nothing makes me happier than a stock market crash. Now, before you think I'm celebrating people losing money, let me be clear, I'm not. I'm rooting for opportunity, and in the next few minutes, if you have any love for building wealth, you're going to start feeling the exact same way. For the long-term investor, winning isn't about guessing the next hot trend. It's about buying shares of phenomenal companies at phenomenal prices. And when do you find the very best prices? During a market crash. It's the ultimate sale on Wall Street. This feels counterintuitive because, in the moment, everyone is panicking. The news is screaming, sell. But the greatest investing opportunities are born from this chaos, from the moments when the future seems most uncertain. If you don't have a plan for crashes, you're not investing. You're just riding a wave until it inevitably breaks beneath you. Let's look at history. Imagine you bought the Nasdaq 100 ETF, QQQ, at the absolute peak of the dot-com bubble in March 2000. You would have watched your investment plunge over 80%. Most would call that a disaster. But here's what actually happened. If you simply kept investing the same amount of money consistently all the way down and continued until today, a strategy called dollar cost averaging, you'd be looking at a stellar 14.5% annualized return. You started at the worst possible time, but your discipline turned a catastrophe into a triumph. While the market always goes up over the very long term, it doesn't do so in a straight line. The path is messy. It zigs and zags. There are periods, sometimes lasting over a decade, where it goes sideways. Why? Because people get overexcited, drive prices too high, and then bad news causes a crash. But this is a necessary process. It's during these downturns that value is built up for the next massive bull run. Think of it this way, in a crash, stock prices fall much faster than the actual fundamentals of the companies. Great businesses are temporarily sold at bargain bin prices because fearful people are dumping them. The smart investor isn't trying to buy at the very bottom. They're buying all the way down, confident that the price they're paying is a steal compared to the company's real worth. This is the critical divide. Speculation feels like investing, but it's not. When you buy a hot stock because your friend swears it's going to the moon, that's guessing. That's gambling. True investing is a process. It means you know what the company is worth, and you've waited to buy it for less than that value. Speculators get wiped out in crashes because they have no anchor. When their hot stock drops 30%, they panic and sell. An investor who has done the work sees the same 30% drop and thinks, the business hasn't changed, this is a discount. One is reacting to emotion, the other is responding to logic. So, what should you do before the next crash? First, do not stop your dollar cost averaging into low-cost ETFs. This is your foundation. For the extra money you might want to put into individual stocks, build a watch list. Create a list of fantastic companies you'd love to own forever and, most importantly, determine the price you'd be thrilled to pay for them. Use tools to analyze their cash flows and value. Then, you wait. You dollar cost average into your ETFs automatically, and you wait for your watchlist stocks to hit your target prices. When a crash comes, you don't see a crisis. You see your shopping list going on sale. The key to executing this plan is having a set of principles that anchor you. Here are the 5 we live by. We are investors, not speculators. An investment is the present value of all its future cash flows. If we don't understand it, we don't invest in it. In the short run, the market is a voting machine. In the long run, it's a weighing machine. A great story can be a bad investment if you pay the wrong price. When prices are swinging wildly, your emotions will scream at you to chase highs and panic sell lows. These principles are your framework for making logical decisions, not emotional ones. Your goal is to always focus on the gap between a stock's price and its value. The truth is, market crashes are scary for most people because they feel out of control. But for the prepared investor, they are rare opportunities. Wealth isn't built by buying when everything is expensive and exciting. It's built by having the right mindset to take advantage of what everyone else perceives as bad times. If you adopt this disciplined, principle-driven approach, your entire perspective will change. The next time the market crashes or corrects, you won't feel fear. You'll feel a sense of opportunity. You'll be ready, and you might even find yourself smiling.